Good morning, everyone. Happy Friday. And I think the markets will be a little quiet today due to the holidays. So that's good. So let's get into our discussion today. We had a couple suggestions. Oh, by the way, I listened to some good podcasts. I want to get that out first. Leda Braga, that's a good one. From oh crap, something Maze. Anyways, she is at Systematica, and she had a lot of good things to say, which I will be reviewing again and tweeting later. But she had a lot of good things to say. I don't think they're too much pure trend following all the time, like I am, but she said some good things, and then they have some other diversifying ideas that they implement as well. But they definitely a large firm and someone to pay attention to. Then, oh yeah, I listened to Tim Pickering on Top Traders Unplugged with Niels. That was pretty interesting. I'm going to be on with Niels tomorrow. Well, we're going to record tomorrow morning. So I'll probably have some comments about what Tim says. He's aggressive, so I don't want to get him too fired up. But he definitely has a lot of opinions and things. Oh yeah, I really like this new Top Traders Unplugged series that Niels is doing with allocators, with the allocators and Alan Dutt, good one. I learn a lot, and it's kind of I think Alan, obviously he has a trend following background from Abbey, and then he is interviewing all these allocators that I think are friends of his that he knows, and shockingly, they have a lot of nice things to say about trend following as well. And the one this week, the gentleman from Rothschild, he's very good. He's very smart, and he has a lot of interesting things to say. And it's pretty funny. I tweeted one thing, which I don't even think is serious, but I just thought criticizing or talking about discretionary managers. Where are they? Are they going to be there when the crisis hits? Are they in the south of France? Or are they on the golf course? I thought that was funny. I didn't even take it seriously, just joking around. But anyways, good morning to everybody. And we'll get going. I know Bruno, a good idea and a question.
Uh, Hi to everyone. As always, I'm very happy to be here with my trend following friends to discuss the situation in trend following space and the markets and in our lives and in our world. And it's very happy moments for me, very happy part of my week. And so, good morning, good afternoon, and maybe even good evening to everybody.
Hi, Jerry. Hi, everyone. Grateful to be here this Good Friday. Um, yeah, I posted a question on Twitter. Maybe it can get us going. I doubt we will stay on this topic for too long because we talk about a lot of things on this every week. But anyway, um, what I was what I was provoking was, why is it better to evaluate systems on a trade by trade basis instead of on a time series basis? I mean, when you're comparing systems, um, why why is it preferable to evaluate trade stats, average win, average loss, hit rate, and average return for each trade? Why is this better than looking at the past performance of a return stream of these trades a long time? My take is, from a statistical point of view, I okay, none of these things are completely independent. So from the start, it makes it very hard for us to compare trades and or compare days to get any valuable information from it. But I find it's more acceptable to treat trades as independent from each other, than to treat days in a return stream. So when we calculate what is the volatility of the return stream or the correlation of this return stream with others, uh, I I feel we have a flawed measure, and that is perhaps that would be a lot very informative if it was if we could assert some independence. Whereas with trade stats, first of all, you're comparing different markets in different moments in different time spans. So it's I find it easier to consider them independent, each trade. So when I calculate what's my average return, the average return of each trade, I feel I have some kind of valid statistic, much more valid than when I calculate the average return of a return stream of trades a long time. Well, sorry, I think I've got a little lost here, but I would like to hear you guys what you have to say about this.
Well, to me, that's just a fascinating topic, and it is exactly the type of things you want to think about. And I think that someone, our friend from Australia, Nick, he had some comment about one of my tweets, and he said, "Oh, it was like I don't predict and I don't bet." And I was like, "Oh yeah, I don't predict either, but I do bet. I do bet." And I think I like looking at what I do as betting. I mean, I bet you the clients don't like it. You know, it's so politically incorrect. But so so if when I'm looking at these trade stats, I'm in my mind thinking, yeah, I'm kind of betting. I'm going to risk $1 to make 2.5 to 3. My win percentage is 40%, and so now the problem with looking at these trade stats is that there's a lot of things that happen in between the entry and the exit, and most people just cannot leave that alone. How can you not pay attention to all of this volatility and drawdown? There's a lot of stuff going on here, and you're just going to ignore it and not acknowledge it. Well, I wouldn't really go that far, but it kind of sounds like that's what I'm saying sometimes. So, but I think the first step is to look at these trade stats. And then, of course, the answer to all trading questions, trend following trading questions, or quant trading questions is the sample size. And so we're going to total up those trades, entry, exit, and have thousands of these trades over 30, 40, 50 years to look at, lots of different markets, longs and shorts, and total them all up, having traded them all with the same system, the longs and the shorts in all the different markets. And then we're going to look to see what we have here as far as expectation per trade, the average trade profit, hopefully, average loss, average win, etc. So that's where we have to start, I believe. Yes, we do have a good sample size. Yes, my average trade is large enough. I have an edge. I like to have a big edge. Every time I put a trade on, what have I averaged? How many ATRs have I averaged? One, a half? Like a half doesn't sound that large to me. I like 3 and 4. I'm greedy. I want these long-term systems that put off the average trade is 3 to 4 ATRs. I mean, I really like that. And so I can build in my slippage, I can build in my commissions, and I know I still am going to have this edge. Then I will look at, so you can't even go forward with this back test, equity curve back test, without the proper sample size. And so I think that's what really gets lost when there's this concentration on, let's look at this back test. And then, because there's a lot of people who are doing things more than one entry, one exit, and a stop loss, which I don't think that's disqualifies a system necessarily, but it can at some point. I'm not really sure how to count the sample size of the volatility management and how does that fit in. And then it seems to me that there's this love affair, falling in love with what has happened in the past, tick by tick, month by month, see this drawdown? How do we eliminate it? Let's tweak things around to get more return or less drawdowns over certain periods of time. Where I think in the future, um, a good healthy system with these great trade stats and a good historical backtest equity curve, that equity curve could look a lot different going forward. Why? Because of COVID, because of Trump, because of Ukraine, because of the supply chain. Yeah, it's all going to look different. But how about those trade stats? I think they're going to kind of look, hopefully, similar. They're not going to be that subject to um, events unfolding in the future, the many paths, the thousands of paths that can happen in the future versus the one path we've seen historically. I'm copying from Richard now. Take it away, Richard.
G'day, everyone. Look, I was interested in some of the comments that were coming through on some of these recordings of these Clubhouse sessions. And, some of the comments from last week's Clubhouse was obviously they thought that, or some people thought that we might have been a bit tough on Tom Basso, and they were sort of commending Tom on sort of coming into the lion's den, as they call it, to clearly in, a group of people that are opposed to this volatility targeting, and they were commending Tom. And I just thought it was important to say, for a start, we're all trend followers, so we all love each other. The thing that just concerns me is a slight difference in philosophical approach. And when I look at what is the real reason for this slight difference in philosophical approach, it inevitably comes down to your reliance on the backtest. So I did a few posts this week which basically looked at this concept of why are we so, why do we assume that the backtest holds so much forward potential when it is this one possible historical record, and if you change the sequence of events along that historical record, we get a totally different outcome. So that's my concern. My concern is that any technique that relies on a backtest, it relies on the statistics generated in that backtest, relies on prior volatility, historical volatility, all of those things. All I'm saying is that there is a departure in philosophy between how I approach it versus what people that rely on that might approach it, because I view the future as one of change as opposed to a future of repetition of what's happened in the past. So dependent on your philosophy of how you think the future events are going to unfold, if it's a simple repeat of what history's brought, I agree with you, then a backtest suddenly has significant merit. But if there is a chance that future events unfold in a different way, I think we cannot rely on that backtest to make decisions that influence our classic trend following approach, like volatility targeting, like all of these things that are relying on predictive certainty. I think personally that's where the distinguishing thing in our philosophy comes from, and it's our approach to uncertainty or certainty.
I want to say that I like this point, and I like the words of Jerry today, and I appreciate much the words of Jerry in episode number 13, as I remember, of Systematic Investor, where Jerry said that, I don't remember exactly, but he said that this trend following approach, our approach, allow us to be less not in this complex world. Don't pay attention to these complex circumstances, complex world. And I agree with this totally, that we have our system, follow our rules. Price only, nothing than price is great, because if we will, we always have a room to something complex. We can do everything in our world. I think we can do more complex without even necessarily, if it's not necessary, maybe. We can even a trend following strategy. We can everything. We can, for example, we can describe our trend following trade with maybe some very complex formulas. We can describe almost everything with complex formulas, and for me, I don't understand this complex formulas, but we must do what is necessary to do, and I love Transform for that. That we we must have our system must have amount of knowledge that is necessary to win in this game, not much, not more knowledge than uh, we need here. So I love this point.
Yeah, when we hear a lot of the arguments that come forward, like a lot of people believe that correlation is something to really focus on in managing risk. Now, from our philosophical approach, we say, well, look, correlations are never static. Historically, we've seen that they're varied over time considerably. And also, we've seen how we classic trend followers have actually benefited from positively correlated markets during 2008 or this is when these outliers tend to sort of occur in many different markets. And because we accept a degree of positive correlation, because we're not hell bent on ensuring that all of the markets we trade are uncorrelated, because we believe that a statement such as that is how do you demonstrate that? I mean, we could say that at certain points in time they may be uncorrelated, but at other points in time they clearly are positively correlated. So how can we guarantee in any particular regime that we're going to be trading this uncorrelated sequence of markets? So what we do is we say, recognizing that there is this thing called correlation and recognizing this thing that has been the historical volatility patterns, yes, they have been important in the past historical record, but what we will do with our systems is we will embed risk mitigation devices in our systems, such as our initial stop. We'll let our profits run because we're asymmetrically constraining our system. So no matter what regime you're presented with, we've got the opportunity of targeting this thing called change, and hopefully this change has never been seen before. So it catches a lot of people unawares, and we get this huge bounty from this opportunity that everyone, all these predictors who haven't seen it before, suddenly get it wrong.
I want to say here that I agree with you, totally agree that correlation measurement is not a very good approach. But as for me personally, I maybe don't have any choice now that to find this probability with the correlation, because I think if your capital is enough, correlation is not important to think about this, because really it can change. But if you have a limited amount of capital, and so in this situation we must choose the best markets, and for example, here we are talking about in terms of probabilities because of these circumstances. And for example, I like commodities much in these situations because, for example, crude oil and corn, it looks very uncorrelated, and if we think about this, really it's uncorrelated, a very high probability of being uncorrelated, uh, these instruments. But of course, I understand that there might be such circumstances that it will be very high correlated theoretically. And I don't know all these connections with this, or how can it be, but I feel it. I feel it that it can be such a situation when crude and corn will go into the same direction because of the same reason. And it's complex theories, and I don't want to dig into this. much, but only. But if you have limited capital, I think there is no choice. Only, and I have said this before, there is no choice. Only to think about a probability of correlation, not a correlation. Of course, it's not static, but a highly probability. And if we are talking about, of course, financials, it's very difficult to say here because financials, all financial sector is lower correlated. All sector, I'm sure. I mean high correlated. I mean
Rich,
high
just
correlated. I mean high. I'm sure. I mean high because stocks, bonds, currencies. I think there is one center of these central banks, etc.
Rich just reminded
Another,
me.
another thing.
Oh, just real quick, Jerry. Um, Rich just reminded me one reason why trade stats are better. Um, when we shuffle the order of the trades happening, the the return stream they produce can get completely different. Whereas when we are looking at trade stats, it doesn't matter the order of the trades. So that's another reason why I find it more reliable upon.
Great point, Bruno.
Yeah, but I think it's beneficial to understand that these losing trades in crude, they happened at the same time that these losing trades happened in heating oil and unleaded, and the drawdowns as well. So I like to look at both and take that in consideration. But at least for me, the starting place is going to be the healthiness of this system are those trade stats. And then I think you have to convince yourself, like I have, don't worry too much. I'm choosing my words very carefully here. Don't worry too much about what goes on between the entry and the exit. You've got the losses covered, right? We got those covered. Small loss, 20 basis points, 50 basis points, whatever your money management and your number of markets that you trade, right? Okay, so that's no problem. So then, and this system makes a ton of money. And per unit of risk of like I measure my systems in terms of if I risk 20 basis points, how how much am I going to make? What's my average win? That's how I measure. I don't look at Sharp or drawdown necessarily because all the drawdowns are going to come from the very profitable trades. So if you convince yourself that that's what you need to look at, these systems make the most amount of money. These long-term systems, okay, but they have these monster drawdowns. Yeah, from peak. But at the end of the day, you make more money, even risk adjusted, if you use the proper, in my opinion, risk measurement. But then if you do this fall targeting or this, and you look at the equity curve, it's kind of like you're long crude since yesterday. Now, what are you going to do? And I'm like, oh my God, I don't know. I got to do something. And even Tom kind of mentioned this, Tom Basso, which we did kind of pick on him a bit, I think. But I mean, I thought he was very well equipped, and we didn't change his mind one iota. And, you know, it was fun. And I think he'll come back and talk to us again. But uh, yeah, even Tom mentioned that in his. He said, "Look, something like the the client looks at it from yesterday. The client looks at it from peak, and I'm going to look at it from peak. Like I will criticize mark to market, well, not criticize it, but the lack of mark to market on private equity. It's a joke, right? Um, but he was almost saying like, well, that's not our business. Our industry, our business is mark to market. It's in the client statement. They see it. I see it. I'm going to pay attention to it. I cannot not pay attention to it. You live in your little fantasy world with trade stats and don't pay attention to drawdowns, but I'm not going to do that. No one's doing that but you. And I'm like, okay, but it's a tough job. The degree of difficulty is so high because I look at crude as I'm long since November 25th, 2020. Oh, crap. I mean, man, you know, that's pretty easy. Yeah, it's a huge profit. So there is no money management, there's no risk there. It's just me watching this thing fluctuate. I didn't get out, last week or two. So now it's coming right back. So I'm a hero. My systems are great. And you just need to psychologically and mentally tell yourself that you're trading the best systems possible. They're making the most amount of money per unit of risk. The loss that you would take. Yeah, November 2020. That's where I got into crude. And Tom got into crude yesterday, or at the highs. Which how do you? That's such a difficult game to play, and it makes less money, and it's warehousing this risk. He needs those mega profits like I have next year when things are tough, or later this year when things are tough. Don't even talk about the sample size issue and how it's not as robust. So there you have it.
I fully agree with this, and I want to say that in every field I know, to be successful, we must have clear goals, clarity. Clarity is one of the main key for success. Clear goals, clear rules, and of course discipline to follow these rules, and of course good rules, like Jerry always says. Good rules. We must have good rules with a big sample size, with a logic behind this, with all this. And it's a very good key to success. And of course, ability to handle all this pressure. And not to, as I always say, not to maybe think about this as a pressure. Of course, yes, it's not very easy to listen something bad from investors. It's not very easy to psychologically to see our drawdowns, but we must be confident and love what we do, our system. Understand that it worked. I'm sure, pretty sure, absolutely sure that our principles of trend following works for thousands of years, and not even in trading activity, not even in business, but in very many areas of life of a planet. Maybe here, as I have said before, we can see laws of nature here, and it's wonderful. And so trend following has to have to offer a lot of benefits to a personality, to a clients, maybe to even all the world, to be more healthy finance system, because it's pure trade, pure trading, pure business. Here we follow the price we see, and we use our rules, our good rules. So we must understand all this philosophy, and if we understand this, we decide, do we love this or not? And if we love this, as I love it, because it's a great philosophy, and I love it, we must handle all this and don't consider, learn to feel comfort in this maybe uncomfortable for many people situations, circumstances. And we can say, as I have said in the beginning of my speech, clear goal. Clear goal is a long-term good performance, and we have a lot of evidence that it can be only like this.
One of the things that goes against my grain a bit is this requirement to market, because what that requirement does is it builds in this assumption that returns need to be generated at all times, every time. So it's almost basing this requirement, when we're looking at market, that the better funds are those that are consistently generating returns. But that sort of flies in the face of how the classic trend followers generate their returns, and they're waiting for these volatility clusters. They're recognizing that returns can't be generated consistently all the time. It's not a cash flow generating exercise. In a wealth generating exercise, you can't make the assumption that returns are going to be generated at all times, every time. So the market is almost like an aggressive move against our philosophy, which I sort of think puts too much sort of expectations on immediate returns, 1 year return, 3 year returns, 5 year returns. And this whole concept of building wealth over decades, which requires you to accept the fact that returns are sporadic in nature, they're lumpy in nature, they cluster, that sort of flies in the face of what we're trying to achieve.
And I want to say that
I agree, but my crack researcher is in the clubhouse too, and he and I have done he has done some research, and I did some research with other people, and I will say that my research indicated that these these type of long term systems with one entry, one exit, and a stop loss, they were the most consistent at having a positive return over the trailing 12 months. And I think I even mentioned that Mike did a research recently where he went back to 1977, and that system, those systems, it's not just one, it's a group of them in that 100 to 200 day range, look back period. And one of them he looked at, it had made money every year since 1977. So all I say, and that would not have happened in real life because of slippage and commissions and fees, and then it depended upon some of the assumptions you have to make going from like 15 or 20 markets, and how do you integrate 100 markets or 150 markets, as these new markets come on. So but look, when I did the research 10 years ago, it was the same thing. You couldn't find systems that were more consistent on its own annual basis. Um, there's some luck involved, but that's the ironic thing. You can sit there and you won't find systems that have bigger drawdowns either. And they make the most amount of money. They're the most consistent, and they have the biggest drawdowns. Yeah, I mean, is anybody surprised by this?
I'm not surprised by this. I'm happy with this because yes, I had also my research on this topic, and I want to say that it's very interesting that it's maybe hard for many people to understand this, to handle these investors and traders. They want consistency, but if we are talking about investment horizon, 3-4 years maybe, and if we have a massive diversification, uh, it's maybe 2-3 years investment horizon, maybe less. We have a very good consistent return when we see all this, and but people don't maybe our world now mentality mindset of people organized in such way that they want some instant results and big results, and maybe because of Hollywood films, I don't know, but in fact uh, we can have instant results. For example, if we are working on a construction building, for worker in a construction, he have his results every day. He have his salary, maybe even every day. In Russia, construction workers have a salary every day. Some workers. So, but it's loss of little money, not business. It's not a loss of business. Owner of a construction business pays his workers every day because he wants them to work for him, but and he haven't his profit every day, of course, and every month. He also have a profit maybe in a year or maybe 2-3 years. I don't know this, but I think so. But he pays his people. But it's not a loss of a business for them at all. It's only because they must buy food and nothing else. So when we trade the markets, we are dealing with a loss of nature and a loss of business, or laws of money making, and so we must do the things according to these laws.
On the topic of mark to market, I think, obviously I share some of Richard's concerns that it might not actually work very well for certain type of investments and trend following in particular. I think this decision or this debate sort of happens a little bit above our pay grade, and I think it has to do with the way financial systems are designed, when you have an interplay between leverage and convexity, meaning when you are, trading on margin, I think it's kind of dangerous to, not enforce or not be willing to enforce a somewhat frequent um, thresholding and measurement of collateral and exchange flows to support changes in collateral valuations. So I think that's the main reason why we're sort of forced in this paradigm. And actually, I think I did say in previous rooms that most of my business choices are also driven. Sorry, most of my risk management choices are also, you know, driven by business model choices. And much in a way as I love what Jerry does, I don't think I can afford to say, well, actually, I have two equity accounts, or well, don't worry about open equity drawdowns, because by definition, a trend following system is in drawdown. I don't know, 95% of the time. So I mean, like we hit peaks and then we sort of come off a little bit or a lot. And so that's why most of the things I do span from reconciling frequent measurement of portfolio values and also optimal portfolio construction in the context of these constraints that we have. And lastly, on correlation, I think I once again agree with Richard, but there's many different ways to look at correlation. There's not just Pearson's correlation and this numerical representation. There's many different other ways of understanding and modeling this parameter.
Yeah, I think what at least I know what I meant by mark to market. It wasn't so much what you were saying. I agree with all of that. It was more like, does the trader, does the researcher, the person who's going to put together their systems, are they going to be, are they going to allow this mark to market, this complete transparency to influence the systems that they trade and how they trade and the rules that they have? And that's what I was saying. It's like, no, I'm not going to do that. Just because you can see this drawdown in crude, I know if I let it have a much larger drawdown over an eternity, over a lifetime of trading, th- using that parameter will make more money. And I can now ignore that any sort of drawdown and volatility because it's not risk. I had a risk in November of 2020 when I put that trade on of 25 basis points, and that risk on this particular trade is no longer relevant. So, um, and I wanted to comment on your second point too, but I forgot what it was.
The one on correlation, how to measure correlation, or the one about not being able to distinguish equity into different buckets. Because I think I agree with everything you said back to me. And again, I unfortunately I had to calibrate my expectations, my business choices to the sort of people I cater to when I go out and look for potential investors. Whereas you have a lot more freedom than I do. So most of the choices that I've settled for were also function of how I saw myself raising assets and raising money.
Yeah, but once again, these systems have the best performance and they're the most consistent. So at the end of the year, um, that's it could be uncomfortable, but it's going to be uncomfortable during a very profitable period.
Oh, no
I
question.
Yeah,
I just said that I couldn't be as good as you are sticking to this knitting and say I'm going to maximize always and no matter what single trade performance. I mean, I agree with philosophically you guys have a better system. It's just that as a business I struggled to make it work basically, and I had to settle for these other things.
yeah. Another thing too, I had this brilliant tweet this week that no one liked, but and it was kind of like, oh yeah, it was kind of trying to sum up what I was trying to get across with Basso, and that is, oh yeah, my friend here in Tampa, he tweeted something about Yeah, they keep bringing this subject up and ignoring. I don't like. We have good. Everyone has good points. I just don't ever ignore it. Like I get spoken to by people on Twitter as if I never had, like they just ignore my the points I made previously to the same stupid question they're asking me, and it gets a little frustrating. So one of the questions was, um, if you're against this whole idea of creating a system that suits your personality, I'm kind of against that. Yeah, you want to. This trading is hard. You're going to lose money. You should seek a system that pisses you off that you hate because it's probably going to be a good system. However, I made this one caveat, and there's probably other caveats I'd make as well. Choose the size that you want to trade. Whatever size you want to trade, that's your personal choice. And if you want to try to make 100% a year or 10% a year, okay, that's not a controversial thing. And I think that is the type of discretionary choice that I think is good. My friend on Twitter, he said, well, if you trade too large, it doesn't do you any good to have a system that is too risky for your personality because you won't follow it. And I agree. I agree with that. So trade smaller. However, that's the solution. Don't corrupt your system with non-robust ideas like vol management to satisfy your personality. Um, I I do have these big drawdowns, but I trade 200 markets. And so my drawdown in a crude trade or in a, just think of some of these trades, nickel and natural gas, UK natural gas. You know, from an ATR perspective, and honestly, I think you should use the entry ATR, which I do. These things are horrific. These drawdowns in ATR terms are difficult, but not in percentage terms. Because I trade 200 markets. So, okay, I'm trying to build this thing, maximum risk, protecting capital, making as much money as I can, being as clean as I can and as honest as I can and as robust as I can with the choice of parameters and the number of variables. So I've got to give in something, and that's what I give in. I look at it, I made 100 ATRs, but now I have a 75 ATR drawdown in this one trade or something. This can happen. It does happen. Ruble, I'm still short ruble. It gave back all the profit virtually. My system hasn't been hit. It just rallied ferociously. So, okay. So I think that's the compromise. And that's what I'm saying is that it's painful to see, but it's one out of 200 positions. Now, if all the grains went down, or if all the currencies rallied, and all the interest rates rallied against me, okay, that's another decision that would be more painful. That's a lot of ATR give back and a lot of percentage profit give back. But anyways, that's how I'm trying to convince myself and work on myself to choose the hard things to do and to choose doing the right things and the hard things. And they're the same thing. And I'll never give in ever on defaulting to a methodology that suits my personality because it's hard and I don't like giving back profits. This sounds like what children would say.
By the way, this problem with suiting the personality, it's not only trading problem. It's a lot of, I think, it's my own opinion, that a lot of courses, business, online, different courses, business trainings, they say that you are unique, you love yourself and something like that. And I don't agree mostly with all of this because we have of laws of nature, and we must love nature. We must love the laws of nature, and we must suit for the nature because it's like I said in the previous our Clubhouse discussion. It's something like a person doesn't want to go downstairs from his apartment. He wants to go to the window because it's hard to him to go to the downstairs. And he said that it's my personality is go straight from the window, and maybe it's 100 meters and something like that. But it suits my personality. I'm joking now, but in fact, something what is very easy, that looks easy, that suits to a personality of a most people. And so it's something like do the easy things, and it all will be okay. Or maybe do nothing if you want to do nothing. Really do nothing. Don't be a trader. Don't be a businessman. Don't do anything. Do nothing, and have your maybe welfare and something like that. Here's my point.
I really enjoyed that podcast with Alan and Hugo from Rothschild. It was interesting. As Hugo was speaking, I thought, is this Jerry speaking or is this Hugo speaking? Because there were so many points he made that sort of add a bit of strength to our cause. He was certainly saying he will not allocate to people that are looking for the easy ride. He'll be looking to allocate towards people that do the hard thing or the right thing. And when he said that, I thought, my God, this is Jerry speaking. And it was actually quite interesting in the discussion that Hugo was talking about, because we talk in terms of two forms of strategy, one being convergent, divergent. Now he speaks in exactly the same terminology, but he classes one as long vol and the other as short vol. So he views there's only two forms of strategy you can take, which can be classed into either long vol or short vol. We do the same. We say it can either be convergent or divergent. I think they're dealing with exactly the same things. This propensity of price to either trend or to mean revert. That's basically encompasses all of the possible different forms of factors. And then when you look into these factors, you realize that 95% of them are basically, as they said on the podcast, they were in different cabins, but on the same ship. In other words, 95% of them were all convergent plays or short vol plays, effectively, with only about 5% of them being long vol plays or divergent plays, as we'd explained. And I thought, my goodness me, I said, what a fantastic guy this guy is. He's singing our tune.
Corey, he posted something the other day, and which is, I think it's a good topic. And I guess, my bottom line to all of this is that there's just not a great solution. I mean, life sucks. So it's really hard. I'll continue to find hard systems that are hard to do, that are difficult, that don't suit my human personality, and then things will be easy. No, it's not going to be easy. You'll maybe squeeze money out of the market. That's the only thing we can hope for. It's never going to be a final victory over these markets to where we achieve. And then they would ask this rhetorical question: who doesn't want a smoother ride? Of course, I want a smooth ride. I mean, I'm doing what I can. I'm marrying the simple, robust, very loose pants, lot of volatility and drawdown systems with 200 markets. I'm doing the best I can. I'm trying to find uncorrelated or different types of markets, not all stocks, not all commodities, but lots of different things, longs and shorts. But sometimes, like Corey said, look at the CTA's portfolios. They're long grains, they're long commodities, they're long dollar, they're short bonds, and mixed in the stocks. It seems like it's the same trade. It's the same bet. Oh, so don't do that. Well, we have made like 60, 70, 100% if you're Mulvaney in 2 years. So kind of a good thing. And now we're sitting here with, maybe it'll all unfold nicely where we'll get out of these trades. They have their different personalities, their different fundamentals, and we'll get out of these trends a little at a time, or maybe they'll all crash and we'll get out of this one-way bet that we ended up in just by following the breakouts all at the same time. So we won't be up 50%, we'll be up 30 or 35 or whatever we'll end up P&Ling out all of these trades. Yeah, we benefited from this correlation. Maybe it was this one trade we benefited from, this inflation trade or whatever. But I just don't. Who's doing it better? And then these criticisms of the first thing that pops into my head, and they're not necessarily wrong criticisms. They're accurate. But so many times I read these tweets or criticisms about or or weaknesses in trend following, which they're there, uh, but there's no comparison. Well, the same thing happens, but even worse in the stock market, you know. But look how great the stock market is. Exactly. Look how great the trend following in all these different markets has been, with the grains and the metals and the energy and the yen. I mean, it's in the short bonds, and it's crazy. So we had this one standard for the poor old CTAs, and then a whole nother standard for the stock market that gives us about 8% and over 50% drawdown.
And by the way, I had 1 year ago, I had one client, and I have told you about him. He is a smart guy. He works in Silicon Valley in California, and he has 1.5 million United States dollars, and he doesn't know where to invest it. And he said that I told him about trend following benefits, and he said, "Oh, I like this." And he said that he has a problem that he invested in passive stocks, and lost 150 United States thousands of United States dollars a day in Corona crisis. And after that, he began to think about alternative things to invest than SP 500, and he began to invest in my program, and maybe in a month or two, when he saw I had 18% plus for maybe 1 year, then, and when I had 2% drawdown from a high, he said, "What is going on? Why am I losing my money?" But I have told him about the principles of transforming and all this stuff, that I'm losing my money. And he said, "It's not for me. I understand all this, it's not for me. I want to continue to invest in passive stocks." And I said to him, "No, it will be better for you to invest in maybe not stocks at all, maybe to apartment or something like this, but not financial instruments. Maybe land, when you," and I said to him, "invest in land for farms. It's better for you." And he said, "I don't want to be a farmer." And I said, "Yes, I understand that you don't want to be a farmer, but if crisis occurs, and with a very high probability it occurs, sooner or later you can sell your land to farmers, or maybe begin to your farm business. It's your choice, but you will not lose your money with a very maybe high probability. It's better if you have such a mindset. It's better then to invest in passive funds." And a lot of people, it's like Neil said, people prefer to fail conventionally. All people fail, okay, and person said that he will also fail because such economic machine works and something like that because of a crisis, and it's okay. And I have seen this maybe many times. I have seen such situations.
That's a good one, Oleg. When someone says, "Oh, trend following is not for me. I can't handle the drawdown. I can't handle the volatility. I'm going to stocks." No, you shouldn't. If you can't handle trend following volatility and drawdowns, you shouldn't be in the stock market too. That's a good one.
I mean,
Well,
that's right. I was trying to encourage, those who, rather than throwing your money away and trading something that is not as safe and robust as it needs to be, just don't trade. If it doesn't suit your personality, it's really stressful. I agree. And then another thing I believe is that I've seen this happen to me, where I had little problems with my system, where I was doing things that I shouldn't be doing. But it took years before I got punished. And so it's kind of like you look around, you look at this back test, They've made just as much money as people who don't vol management or who taking profits early, whatever you want to call it, and putting in certain convergent strategies in with your trend following. Hey, look, I'm looking around. It looks great to me. And I think that you could end your career and never see a problem. But that's not how I want to go forward. I think these markets, they make me, sometimes they make me think that they're very dangerous because I lose a lot of money very quickly and my mistakes are very evident, but not very often are they evident.
Very good words. By the way, I decided, I've told you before, I invented wall targeting because I didn't even know these words. But in my research, I have found such approach, and I understand that it can be profitable and begin to trade in 2015. By the way, we decided not to talk about this, but okay, it's too late. And so. And in 2015, I began my role targeting
Jerry was
program.
just kidding, Oleg. He was
I was,
joking.
I
Okay.
He
was,
was
I was
just
just
kidding.
Okay.
saying that,
Okay. So I decided
wall
to.
targeting.
Yes, I decided to, and to do this, and I did this, and I have even big client. I remember, but. And for 1 year, I did this wall targeting with a very high leverage, and I get punished in 2016 for that, and by the market. And I was glad that I'm punished, and I thought, oh, how good that I not having a lot of clients, maybe few, and how good that I'm punished now and not in 10 years or 20 years when I will have maybe large fund, maybe will be a famous trader and be punished because people see only performance and invest, and people invest in all what they think to be profitable, and as we know, as usual, it's not the right decision from the clients. They don't understand it. It's emotional decisions, not logic even decisions. Yes. So I was very glad that I'm punished only in maybe 10 months of doing that, but not 10 years. Really very glad.
There's one
What I'm
thing that
interested.
I think about. Sorry, uh, a lot. It's the difference between failing by yourself against failing with everybody else. And when Oleg said about his client that had a huge drawdown in equities, but he couldn't support, he couldn't stand the drawdown in trend following. Sometimes I think it's a piece of conversation that we have in the office very much, if failing with others makes it easier or not to withstand. Because at the end of the day, many people think that if you fail by holding stocks, you have the same issues that everybody else has, and plus you have the Fed put on your side. I always wonder myself if having a 30% drawdown on stocks is easier than having a 30% drawdown on trend following or any other strategy, just because you are with lots of people in the same boat.
That's why we have trend following trading club.
Yeah, to reassure ourselves.
Jerry, Rich.
I've been watching the. You go, Bruno.
No, I think you you were going to mention the chat. I was giving it some air too. I think people are interested in questions there.
Are you referring to the chat on YouTube?
No, the chat here on Clubhouse. There is a question from Jason and an ad an add-on from Rich. If you guys would answer it, I think that'd be nice.
Okay, let's get to Jason's question. I have a question to Professor Richard Brennan and Jerry. as we know that that we have a positive edge in the medium and long term, what are the elements we take in consideration to choose the medium term strategy instead of the long term strategy, or vice versa? Well, just I would choose both. I do. I trade more than one system, more than one time frame. They're all of them are breakouts, but I think that's the key. Um, if you can handle it with your capital, I would trade multiple systems that give me some diversification on the entries and exits. So as long as the medium term has a good, healthy average trade, the trade stat, then I would trade that along with the longer term and things in between. So that's how I do it. How do you do it, Richard?
Yeah, look, I find that my workflow process during the course of doing this intensive sort of exercise of this workflow, I find that my strategies naturally fall within a cluster that span from medium to long term. So I'll be therefore selecting strategies that fulfill both the medium and the long term, like you, Jerry. It's not that I have designed that to occur. It's just that the data and the method I use to evaluate my strategies, and as I might have mentioned before, if, for instance, you conduct extensive backtesting on a single market, so a single history of a single market, you'll tend to find that your short-term systems might float to the top. Now, what I find is when I therefore undertake this extensive multi-market testing across alternative history, so different markets that have a different historical record, the net result of my strategies they get a lot more breathing room because they are what I regard as less overfit to a single historical record. And so what that means is that my systems, which I view as universally applicable across any liquid market, have much more breathing room than if I did a back test, just assuming that I was going to be trading a single market and I did that back test on that single market. That will necessarily give me an overfit response to that single market. And so this is where I argue in your reliance on a single history, you will overfit based on the historical record, as opposed to we as risk managers, which are looking at a different possible future to one that's been presented in the past, and therefore this process I undertake naturally falls on these medium to long term models that have got much more breathing room, much more loose pants than what would otherwise be obtained if I just did it on a single history.
And let's look at one more question here. This is a good question. This is a interesting question here from Rich Vanderhoff. Um, if you're following a trend in a distant futures contract, he's in April 23 Nat Gas, would you use, for example, the 100-day low for that contract, or keep an eye on the active contract for exit? Oh, okay. I wouldn't do the latter. I think it really depends upon one most important concept, and that is choose how you're going to do it and stick to it. So I use the continuous contracts in almost all the markets, and so I would use the continuous contract that I create. And but if you want to use the individual contract, a lot of that's fine. You just stick to it and don't go back and forth. And a lot of okay, so back in the day in 1984, we traded short term enough to where every contract had enough days, 20, 40, 100 days, right? But now we trade so long term that if I have a 200-day system, there may not be 200 days in that particular chart. I'm trying to think of some charts, but there's definitely some out there. And so I default to using the continuous. Now, I would choose to use the contracts when I have determined, this is not, I don't think, too controversial, when I have determined that it's better to use the individual contract because you're getting because it has lots of liquidity and it has lots of data and it has its own kind of personality that you're going to screw up. And personality is not a good word by doing a continuous. So I think nat gas, no, not nat gas, the emissions contract. I think it's just December is the most liquid month, December of every year. So I just use December. And then I think for the short-term interest rates, euro dollar, short sterling, Euribor, Canadian bankers' acceptances, Australian bank bills, I use a contract there as well. Lots of liquidity. It's different places on the yield curve, and connecting those short-term interest rates doesn't look correct to me. Underline look, it looks stupid. The chart doesn't look right. So that's how I do it.
Yeah, the consistency point I think is the most important here. And if you're trading the I don't know 6 contracts ahead of natural gas and looking at the active contract to get your signals, what are you going to do about when you're trading the active contract of natural gas? You don't have -6 to look for signals. I would build a continuous series of that 6 contracts forward and look at the prices of this continuous series just for consistency.
I think looking at contract to contract is fine. I don't think it's any more or less consistent compared to a continuous. All I'm saying is when you choose contract by contract, stick to it. Um, and I think what happens is when you switch to the new month, then it could look like a whole lot different chart. And so you could say, well, when I switch to the next month, I should be out. I mean, sure, and you wouldn't be out in the continuous contract, but I don't think that's a problem because the continuous contract has its own set of issues. One would be things like old crop, new crop, where July corn and Dece corn can look a lot different. And if you create one continuous contract, you're ignoring that fact. And I've heard Moritz and a lot of other CTAs say, um, well, I trade as many of these different months as possible as if it's a separate market. So yes, July corn and Dece corn are way different. I don't want to, and I'm going to put both of them on. You have on soybeans, you have 4 different wheats. I have like 5 wheats on. And then I'm going to have 2 corns on at least because I'm going to get some difference here. I may have 2 different Eurodollar months because I'll get some diversification there. I personally don't go that route. That's different months of crude, different months of Eurodollars. I don't do that. But I think that there's no perfect answer for in futures in every single situation how to handle these data sets. But maintaining a consistent approach seems to be one of the overarching rules in all of trend following is whatever you're going to do, just keep doing it and try not to change too much.
Yeah, I agree with you. I think I wasn't clear enough. I tried to explain myself here. Let's take, for example, the euro-dollar contract. You can trade the active contract that's the nearest one, and that's going to settle 3 months ahead. And when it's getting near the settlement, you switch to the next one. And when you build a time series of the past price action of euro dollar, you have this chain of 3 months contracts, and that's where you're going to extract your signals from. Then you can have a different, similar but different market, and let's call this one the 2-year ahead euro dollar. So you have a similar chain of contracts, but instead of piling the active contracts, the nearest contracts, you're piling always 2-year ahead contracts. So today you would be looking at the June 24 euro dollar, and then 3 months ahead you're going to switch it to the September 24 euro dollar, and on and on. What I'm saying is I think it's more consistent if you build these continuous contracts of different settlement dates, and extract your signal prices from there instead of looking at the active contract now to try to extract any signal for any contract down the curve. Okay, sorry if I made this a mess. And Jerry, I'd like to switch topic here, if you guys would like to. One of your tweets this week got me really intrigued. It was something about using the open, the close, the high, and the low information from prices, and that's about it. That's enough, more than enough for you to make money in the markets. And then someone answered you, oh, I just use close, not even the high, the low, and the open. And then I think you answered that you too use only the close. Now that got me really intrigued, because I calculate my ATRs using the high and the low, and the close and the open too. I look for breakouts looking at the high and the low within the day, and now I'm lost. What you guys are doing? Just using the close?
A plus. You're the top student. There was a hidden Easter egg there, and you're the only person who called me out on this. Exactly. So yeah, this was a good comment, because I was commenting on somebody saying, more data, more machine learning or AI, and more data is always great. Quantum mental, have you heard of that term? If you can't add anything to the trend following fundamentals, I fade the fundamentals, if anything, but you can't add more information to the trend following. It screws up your sample size. So anyways, um, but I think, yeah, so I said, well, all the data you really need is open, high, low, close. And then Michael came back and said, well, you use 300% more data than I do. And I was like, yeah, I was just trying to be funny, but I have to admit, I only use the closes as well. So I'll give you an A for that. And I'm not going to say, oh, no, that when it comes to the ATR, I use more than the close, because I don't. Now, but I'm not going to tell you how to come up with a superior ATR by not using the open, high, and low, and only using the close. So you're going to have to figure that out for yourself. And because now I made another claim, it's superior. So even with less information, how in the world can you possibly come up with an ATR without the open, high, and low? I'm not going to spoil it for you. I will give you an A. So we see if you can come back and get an A next week and tell me and prove to yourself um, why an adjusted ATR calc is superior. But good for you for. And we did a back test saying what happens if we wait to buy and sell on the open. Really, you can't really do it on the close legitimately. So you wait, you get the signal on the close, and then you buy on the open, or you sell on the open. And it administratively, with so many markets to watch throughout the day, it's easier just to wait till the morning and do all your trades. But and then our back test was that you make a little bit more money, so it's probably a bit random. It doesn't really matter. Now you're going to get some bigger drawdowns and some very unfortunate days when you wait till the close or the next day. Like during COVID, that was kind of really a bad idea, because the markets were moving so much, and you could have a strong close or a weak close and the next day it would gap down before you even had a chance to do it. So it's not without its risk, but it's pretty much the same as trading intraday.
You get me laughing here. Thanks for the compliment. And okay, challenge accepted.
But the ATR based on close only, it's basically volatility standard deviation, no?
Maybe it's highly correlated to ATR, but the ATR is not as good because it's missing some information in some markets. And there's a unique characteristic that the ATR should also help you observe in the markets. So, as I've said before, I throw all this information into a back test and I try to figure out. But some of these calculations like that, you can put it in the back test and try to optimize the back test. You know, what ATR should I use? How should I calculate the ATR? And for most people, like, what? Now you're telling me I got to calculate the ATR in a different way? For God's sakes. I know. I wouldn't worry about it too much. It's not that big of a deal. But um, so I would just notice some of the things in some of the markets by looking at more of a spreadsheet approach to see how the markets are moving around. And I would kind of notice that there was some anomalies there that I sort of tried to figure out why they were occurring, and the ATR calculation for some markets was more accurate than it was in other markets. So in order to come up with this quote unquote more accurate, I had to have a philosophy of how this ATR should change each day and what some of the characteristics of the markets were. And so this was more adept to a spreadsheet approach as well. So I wanted to hit it for two different ways: this back test and more of a calculate, get more information from the data in more of a database slash spreadsheet way. So yeah, I don't think it matters a great deal, but when I've explained it to my friends, they're like, "Oh yeah, you're right. I see where you're coming from now." So, but yeah, you can. Another thing too I like about using closes only is I used to be very obsessed with cleaning data. Cleaning data. I think for trend followers, I think it's kind of misplaced concern. But anyways, if you only got to concern yourself with the close, then it's you're going to have less error. And the close is the only price where, well, I think it's the price where the different data sources agree the most. There's more. Certainly, the open is subject to interpretation, and we used to clean open, high, low, close every day with multiple sources, and so this just makes it a little bit simpler and less work during the day.
I'm hoping that everyone is getting full benefit of all of these trends that are occurring at the moment. I was having a look at Paul Mulvaney's fund, and I noticed since 2020 he's now pulled about 120% returns from that low point. And I'm thinking to myself, goodness me, wouldn't it be fantastic if rather than the classic sort of retracement that inevitably has occurred over the last 10 years, we see for the next few months these trends continue to extend. Because what this will do is there's already significant attention now being focused on CTAs. You see that everyone now, it's that Jerry picture of those two attractive girls saying, oh, he's a CTA. They're now starting to all pay attention to us. And I'd just love to see this acceleration of the trend followers away from that S&P over the next 3 months to such a point which hasn't been seen before, where people start really questioning some of the things they might have heard over the past, like trend following doesn't work or whatever, is going to sort of put this attention on us that hopefully has never been really seen before, in saying, what is it that they do? What is it that's so significantly different? Because maybe this is what's necessary to give us a new sort of revitalized life in the financial markets, where we get the recognition we deserve.
I agree, but also I think it's a good lesson for CTAs because they can just listen to what you say, or where that you can't predict these things. You don't know how far it's going. There are no patterns. Looking at history as how far things have gone and how the markets have worked with trend following is not a good indication of the future. Um, get your entry, get your exit, put your stop loss in, trade as many markets as you can. You don't know what's going to happen. You're equipped for the future, but you don't know what this future is going to look like. And so these unprecedented moves and trends where people are so focused on different ways to get out of the trade before the breakout exit gets hit or before there's a meaningful drawdown, because history has shown us that these things can end poorly when they don't last that long, blah, 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 on, which history is not a good guide. You got a 5,000 trade sample size with a good average trade and a decent win-loss ratio and a good win percentage. That's what you got. That's all you've got. Go forward, and you'll and take comfort in the fact that you don't pretend to know anything else.
I think this is a good time to stick to your rules as well, because obviously with all these large trends, our emotions might jump up and we might get anxious, or we might get excited and disregard our rules. So this is also a good time to have a reminder to stick to the rules, whether it goes up or down.
No red Ferraris, Jeff?
I remember in 2015 it was the first time. It was like the tail end of a really good run. My first good run since I was in business, and I remember the day I took the calculator out to calculate my impending fee that I was going to earn at the end of the quarter, end of March 2015 it was. And I think that was the literal day of the top for my performance, over the next several years. And since that day, I've always wondered, like, all right, I better not check that calculator. I better not do any fee math because that'll be the kiss of death. But
That sounds so much like, Kenny Rogers and the Gambler song, mate.
yeah. So, but I've done it because I have to, I see all the financials every month that the administrator puts together, and obviously the, fees have been going into my account over the last 2 years, and it's just like, oh my God. But I remember me and Jerry talking. I think it was a couple years ago, maybe it was late 2020, when we're like, should we tell people to invest now because we had such a vicious rally off the bottom of 2020 in March, and we're just like, I don't know, it's maybe wait a little bit. Well, here we are 2 years later, up 100% since. It's just, you just don't know, and it's really, it's one of those things I think that always gets people. It gets the weak hands, where you just get so used to it being a certain way that when it changes, you yourself are even surprised, even if you have a ton of experience, because it's just, you could do all the 50-year back tests. There's not as big of a pandemic or a government response to a pandemic as COVID was. So, that didn't exist in there either. So,
Well done, by the way, Mike. Your Utripid is absolutely firing at the moment.
What? Oh yeah. I know. I'm just doing nothing really special. Just doing it. I think that is the key. Just do it.
Mike is certainly not special.
When are your performance reports coming out, Jerry? Come on.
Oh, mine are out.
These are good too.
Yeah, but I've told the story before. I went back in 1983 before I went to Chicago. 82, 83, I was, teaching reading and trying to understand trend following. And I just became so excited about it. Really just, there's no internet. No mentors. I was in public accounting, and I just pulled out my calculator and started seeing, what would happen when I start compounding 100% per year. And I was so excited about it. And then in 1986, um, there was these big, huge trends in short crude and heating oil and other things were going on too. And I think in February I was up 200%, and I was trading $1 million, and my bonus was $1 million. So I went home Friday, and then Monday I had the worst drawdown I've ever had in my, like 60% drawdown. So I was still up 140. Um, but yeah, it was quite amazing. And I think another thing that happens too, though, at least to me, is that um, Tom was on another podcast, and I tweeted it. I can't think of the name of it now, but if you just check my this week's tweets, you'll see he was on another podcast, and the guy was kind of a really good interviewer, and he was saying like, human beings, we get very nervous when we have these profits, and then um, we get we get very optimistic when we have losses. We don't want to get out of these losses. We don't want to book them. And but oh my gosh, if you get this big profit, you're scared to death. You're going to lose it. And he said we need to flip that. And I'm like, yeah, we need to flip that. With our rhetoric and with our actions. And so often, I have come into these periods where I had these massive profits, and we have a couple of really bad days, and you're like, I'm not going to get out. I'm not going to do it. I'm going to get out. I'm not going to allow this trend to take away all this profit. And and that's another mistake. It's just it happens, and it's just something that you need to figure out a way to resist. Don't look at those quotes very much. Trade small, and just keep it in your head that by doing this back test and looking at the trade stats and the equity stats, you're not going to ever do better. It's just right now it's going to be painful, possibly, but over the long period, um, and Lita Braga mentions this in her podcast, the same thing. Over the long period, you're destined to win as long as you keep doing it.
It was Cycles TV. I listened to this Tom Basso's episode, and it was good. But I've started to understand more and more, and maybe one of the takeaways for me today also from here is that it's kind of two different worlds if you're managing money versus trading your own capital. I mean, as I see, like, people who manage money or sell their signals or whatever they do with clients that has to got to do with clients, they take partial profits or vol target because basically I think it's about the AUM, and when you trade only your own capital, you can better do the best and hard thing to let the profits run. And maybe one of the thing when you want to start a fund or manage money, you need to think of the free time activities with your bigger clients, because when I think about trading with my own capital, when I have been meditating and taking ice cold morning showers and working out and doing sports and whatever it's necessary to tackle the stress that comes from trading and with the drawdowns, then I can't even imagine that if I was running a fund, my clients wouldn't have that kind of mental preparation. So maybe it's up to a fund manager to think of that side of his or her business.
And I think that we must not care so much. Maybe I'm not right, of course, here. I'm maybe not right, but about mental preparation of our clients. Because I think that we must educate them as much as we can. So, describe today's situation when I tried to educate a smart guy, and I could not do this. He understands all this by his mind. He understands, of course, he is a guy from Silicon Valley, but he can just can't handle this, just can't. And so maybe if he would be better educated, it will help him. I don't know, really, not don't know. But I think first of all, we must think about our rules. Our so you said that you meditated, you had your sports, something like that, and I think that we must keep doing in this way, no matter do we have our clients or not. Because when we have a good profit, people will say that we are successful, we are good traders, we have a good system. And when we are in a drawdown, some people will say that a trader can't trade in a good way, he is not a good trader. And but we are staying the same. And I think we must, for me personally, I must understand that I must stay the same course, no matter what the other people are talking, are saying about it, because it makes, all in different areas of our life, it makes us weaker. It makes us weak to listen what other people are saying about us. When people say, oh, there is such a great guy, and it's of course it's another side of this, that of course it's very good to be a great guy, a great trader. And they will say, oh, you're a great trader, let's be a vol targeting. It's very good for you. If you are great, do vol targeting, do high leverage, and you will be great. We will say that you are great if you do this. And maybe go through the window and don't go upstairs or etc. And we will say that you are great. No, it's very, very bad approach. We must stay our course, and no matter what other people are saying. And of course, we must educate our clients, tell them about how this logic works, of course, the logic behind the system, how the system works, show the chart, and a long-term chart for many, many years. And I think it's maybe all what we can do here. Maybe I'm missing something, maybe I'm wrong, but I see only such a thing, but not thinking much about the other people, because I don't think it's a good approach.
Yes, but actually, this educating your clients and showing them charts and telling how it all works is, I think, also part of mental preparation, because this is what we also do ourselves, like all the back testing and going through charts and looking at the trades. It all gives this confidence that is also, I think, an important part of mental preparation, because I think back how I used the time in these COVID lockdowns. I made myself a habit that I went through charts every morning for an hour or sometimes 2 hours. I just did it for months, and it kind of built up also more confidence and helped with the mental side.
For me personally, it took years, for a few years, took years to be in such a mindset that I'm having today. And maybe it's different for different people, but I suppose that it's not very easy. Of course, it's when you have a good mentor. I didn't have a mentor. Did it myself before I have found Top Traders Unplugged. I did myself 90% of what I was doing. I maybe so, and I listened somebody read, but I didn't trust much what I have written about this. Maybe okay, but I think that it's not very easy to teach people to think about this. Like Neil said, I appreciated much when he said that we don't want people to think like we think. We want people to think Yes, it's great to think, to see the logic. I think it's very great to educate people. But, for example, we are educating maybe 100 people we are educating, theoretically. And here is a big question. How much from these people will be educated in the end of the day and will trust the system, will be confident? So it's so I think it's yes, it's a part of our work to educate, to be clear, clarity, of course, clarity here, communications, good communication. It's a part of our success in on a business side. Of course, it's a part, but it's we can't do maybe more than we can do. I think so. It's a global maybe problem, mindset of people in the world, most of the people.
I wanted to get back to, I got a little distracted, but I wanted to get back to this earlier comment about, dealing with clients. And it is a very tough situation, to not take, it's very luxurious to have a client who will just let you do your thing. And you would think that there would be more people like that. And then they bury you inside this portfolio where you've got vol targeting CTAs, you've got classic trend, you've got long equity and all kinds of different investments. And, you've made a proper investment in this CTA who is just going to try to maximize the trends. And then you're kind of hidden and left alone and you can do your thing. Um, but inevitably, the allocators are like, and I think that guy from Rothschild, he mentions this, like people will come along and say, look at that line item. It's having these losses. Why is this happening? I don't like it. But it's such a small part of the portfolio. Let him do his thing. But you're still getting this pressure. So you put the CTA in a situation where they can't do what they think is correct in order to keep the assets. It's just ridiculous. And but it's really a situation where the vast majority, especially the larger CTAs who have all the large allocations from institutions, they agree with vol management and not maximizing the trades and the trends. They don't have to be convinced, and they're all in it together. And so, if the mentality of the industry was, look, we're not going to take small profits, we're not going to vol manage, deal with it, then the clients would say, oh, this is what this group does, and I'll have to deal with it, and we will allocate. But if you're this lone wolf crying in the wilderness, uh, and you're 1% of the entire industry, um, then no, why should I agree with you? The rest of the industry doesn't agree with you. The guys with the PhDs and all the AUM, I think I'll go with them because they're trying to make my ride very smooth, and they've kind of convinced me that there is no trade-off. There's no cost to this. It's free. I'm trying to give this to Jerry, and it's a free gift that somehow you can reduce your vol in these open trades, and it's not going to cost you anything. And that's what I want to buy because they've told me that that's what they're selling, and I can get it. And so, that's why there is such resistance to making these changes. But they will change because they will lose because we are correct. And when those profits become harder and harder to get by the way that they're trading, they will never admit they were wrong. They'll just gradually, just like Winton, gradually slinks back into the industry. Oh, yeah, trend following, it may have something going for it now. They will de emphasize all of this vol management and portfolio management as well.
And I think that maybe not a very good example, but I have mentioned it before a few months ago that it looks like similar. The passenger in the plane comes to a pilot when plane is starting to go high to an altitude and altitude and says, I'm afraid to be here. What is going on? Why I'm not in the port of destination now? What is going on? I'm afraid. You don't know how to manage the plane. and so on and so forth. And I will tell you how to manage the plane. I want to feel safe. I want you to fly near the ground, maybe 100 meters. I feel more safe when I'm 100 meters from the ground, not 10 miles, and so on and so forth. And so maybe it's a little another topic, but I think it's what I have said before today. Very clear discipline, clear rules, clear goals. And it's first of all what we must think about. And about the clients, if you ruin your account, I'm sure they will not say, oh, such a good guy, such a good trader, he ruined account because he was listening us. No, they will not. And if you will be in a profit, after maybe 2 years for drawdown, if even so, you will be in a profit. They will come back, not all, but some clients will come back and say, "Oh, I was wrong. This guy is a good guy. His account survived through such circumstances, and they will even invest even more money." And I see that a lot of people invest in funds. I see that. I don't know all this data, all the statistics, but I have seen it by myself that people invest in a fund when they see profit for maybe few days, for maybe 1 week, 2 weeks, maybe a few weeks, not few days, 2 weeks of profit, they invest. And we have such type of clients, I understand that, I have seen. And 1 week of drawdown, they invest in a fund which have 2 weeks of profit at another fund. And it's very inconsistent behavior. And even if such a client will invest in the best traders in the world, I think he will lose his money with this approach. So consistency. First of all, consistency, and first of all, we must be consistent. And maybe with our behavior, so we must tell the client how we work, tell our show charts and what we're talking about today. And after that, show how we do this, show, not tell, show our behavior. And of course, not much clients will understand, but if you follow your rules, I think such a fund will be a fund which performs good in a long time horizon, have good results in financial, I think, in investments also.
I think a good point that Oleg brought up, and but not to beat the dead horse, but nobody's going to the pilot saying, "I want to fly the plane because I can do it better." But maybe that's also again because flying the plane looks more complex, right? So no, nobody dares to touch all those buttons. When people think it's simple, that's when they feel like they can do it themselves, so they can improve on it because they can see the lines on the chart. But obviously, we've just discussed this quite often, so I don't want to go back and forth on that one. But I think that's a good one.
By the way, experience, it's very, very important. And Jerry and Niels and Moritz and a lot of different successful people say the same, that experience, you like maybe Niels said that you can't backtest experience, and Jerry said that you cannot be a marine only reading books about marines. And my father, he is a captain of merchant ship. He is a sailor and captain. So when I was a child, a kid, he wasn't a captain, but he was an officer and of navigation. And asked, and he said that there are such things as an experience. Experience is very important. And maybe I was 10 or 11 years old, and he said to me that there is no such things that can compensate experience. Because I asked him maybe why he is not a captain yet, he wasn't a captain yet, but he said experience, not only knowledge, not only theoretical knowledge. And I said, but your friend, he is a captain already, and he said, yes, he is a captain. He get early, in his early, maybe in his 30s, he became a captain, but um, he said that that such people, such captains are very much, they can have even problems with their health because they not have experience, and they understand this, and they understand that they're in a danger because they are not experienced much, because they were thinking only about money, about their career, and they drink a lot of alcohol. Because of that, they compensate this worriness with whiskey. And it's not a joke, it's really so, because my father is a captain and I know this.
In my experience, investors don't care how you do it. They care why they want to buy it. Right? My wife is in sales. She works for Spotify, and they have a saying over there. It's like every time you say something, it's so what, so why, so what. Oh, I go with the trends. Okay, so what? What? Why is that important? You know. So I think you always need to stick to that um, mantra if you have clients, if you're your own trader, whatever. But you stay on point with why someone would want to invest this way. The 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 core reasons, and just hammer it over and over again. And you know, but I think once you start like pulling up charts, I'm not saying it can't work. For a time, just to kind of set the ABCs in motion. Like, oh, here's what we do. Okay, here's how we do it. Oh, okay, I get it. That's cool. And then from there on out, though, it's going to be a lot of the why reasons. And some people just don't. They forget after a while. I've had 40 investors since my inception. I probably have like 30 now. So yeah, about 10 have left, and no one comes back. Because they just didn't want it or whatever. And I might have been lucky to even have them in the first place. But yeah, in my experience, that works the best when people are fuzzy on whether to invest in this because it might be their first time, and they can read all the books they want, and listen to all the things they want. But a lot of the discussion out there, including in this room, is for traders, is, what to do technically, this approach, that approach, it's kind of the X's and O's of trading. But for an investor, they don't care about this. They want to know why. Why do I need it? Why is this important? Why is writing the breakout important? Why is trading the trends? Why is portfolio diversification? Why can't we just buy a whole lot of this and go with that? Why isn't that a good approach? Well, here you go. And then you got your entry point, and then you can educate that way at a point of a question, a pain point, which you're going to have their full attention then. And that's it. It's just, you're just finishing, you're just filling the gap. Yeah, that's what I found works best. And I think that's the most like helpful human thing to do. You're not like coercing people into, look, you need to see it my way. Okay, here, look, idiot. Look at this chart. Once you start like having that sort of approach where you are on this high horse, you are this master trader, and you are talking to someone who's not invested yet, and if you were smart, you would know that you should invest with me. Like, you can't have that either. Some people go down that rabbit hole really quickly, and they're just not like, hey, here's trying to be helpful. Here's why we do it this way. Here's why we think this way. Here's why we approach this way. And that goes I think the learning curve goes is much shorter. You get feedback, good feedback, much quicker.
Interesting opinion like this. And Neil said once, I remember that it's better to tell the clients about benefits of trend following than tell them a lot of something from the technical side.
Yeah, I agree with what you said, Mike. I think it helps that people are greedy too, and that they want to make money, and some of them don't really care if they don't have investment committees. High net worth people, they may go for relationship, and but I do think that people sometimes like to know you are an expert. I mean, you can come across as arrogant, but I do think they want to give the money to experts, and so you want to come across as knowing what you're doing and being able to make money, uh, but not as a arrogant hedge fund person. And then, yeah, I lost my train of thought, so I'm going to pretend like I didn't. But all right, I'll be back. Sorry. Okay, I remembered. So another thing too is think of me sitting in my office in 1983, and I am and I'm learning about trend following. I'm reading books. I'm watching, reading newsletters, Marty Zweig, and trying to understand trend following. And I fall in love with trend following. So then I just think that once you explain it and you get the basics down, and in my own simple way, I was like, okay, wait a second. I see what's happening here. Are these small losses going to be paid for by the big profits? That's the question. And I'm like, maybe, hopefully, we'll see. I love this idea. I love the max diversification, the shorts. This is fantastic. And so instantly, without any help, I was sold. I was in love, and my love has only grown. So we get in front of these clients and we try to find these perfect words. We try to be good people. We try to do exactly what you said. And they're like, no, 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 it just doesn't ring true to me. I don't like it. Okay. And so that you're going to get a lot of that too. And I think that's okay, because finding people, I'm not saying they have to be like me and instantly understand it and love it, but the Clubhouse, the Twitter, there are a lot of people out there who understand it, and trying to pretend to yourself that we need to educate people more. We need to find the magic words. There's nothing more explainable, and there's nothing more that we all like a lot. We didn't have to be overwhelmed with math or logic or the perfect words. We understood that concept from the very beginning, and our affection grew as we learned more. And I think sometimes there's just the population of the world out there, the investor world. It's not 50% trend followers. It's 5%, 10%, and so this is what happens. And I guess that's okay. You're just destined to have kind of a smallish business, maybe, but it's a good business. It's your business, and it's your fund, and you're able to get a lot of joy and a reasonable amount of wealth out of it. And you don't have to be billions, because with those billions and with those large organizations, it's inevitably going to come these compromises that are going to get you further and further away from the basics. It reminds me of that quote that I thought was so funny. Someone on Twitter put out last week, and I mentioned it last week as well. And it was, I wish I didn't know now what I didn't know when I first started. You know, I've been corrupted by some of these ideas, and I've extricated them from I've recognized my mistakes and tried to get rid of them. All this extra knowledge I've gained that is not helpful, but it's still there. I still have it. I still have the scars. I felt for Tom, because one of the things he kept bringing up is this silver trade, silver trade. And I was like, oh man, yeah, you see, that's what happens. You have these trades and they scar you. And that's pretty much what he kept saying about, hey, look, I've got to do things this way that I do them, because of this silver trade. And this trade may have been in the 80s. And but he can't get away from that silver trade. And I think that when you have these trades that work out so bad and you give back so much profit, or you have this big loss, you can spend the rest of your career having that to be an influence, positively, rightly or wrongly, on what you should be doing. And I think that most of my major mistakes have just been in not following my system and over trading, but certainly only paying attention to breakouts and possibly giving back big profits because the breakout exit is far away is not something that I would say has harmed me. It's quite the opposite. When I haven't done that, I've usually paid a price for not being willing to let the market do its thing and naturally come down and hit my stop loss, my trailing stop. But it is a major issue we all have to go through to try not to let the past and our past mistakes, and to properly identify them. I know there's been many times where I misidentified my mistake until I finally realized, look, the big mistake was just trading too large and having a big, huge profit and loss swings. Oh, anyways, I'm rambling, and I'll use this as a time to say goodbye and wish everybody happy Easter, and happy Passover, and thanks for everybody being here. And we'll do it again next Friday. Have a good weekend and a good week. Thank you, everybody.
Thanks,
Thanks,
everyone.
everyone.
Thanks, everyone.
Bye.
Bye.